Bandhan Mutual Fund presents MF Corner.
Hello and welcome. You're tuned into the special Mutual Fund Corner, the YouTube edition. And joining me today is Prableen Bajpai, the founder of FinFix Research and Analytics Private Limited. Prableen, thank you so much for joining us today. And, again, today the conversation is not going to be around where should one invest or which is a category which is looking good right now. I want to understand how important are ratios when it comes to mutual fund investing, because these are, again, the basics that every investor who's investing should know about as well, right? So let's start with the basics. How important it is to look at ratios when it comes to mutual fund investing. You can look at returns, but ratios do matter.
Absolutely, returns are the top, thing that investors check actually. But I think ratios offer a lot of valuable information, Sonal, on how the fund has performed. So on three aspects, it is the performance, it is how your fund management has done, of course, which reflects in the performance of the fund, and of course, how the fund is placed in terms of its risk profile. So these three things are, I think, brilliantly captured by various ratios. So for example, your beta and your standard deviation can tell us a lot about when we're assessing the risk of a certain mutual fund scheme, while ratios like Sharpe or Tino or R squared actually tell us how has been the risk adjusted return, because for any equity investment, we do undertake a lot of risk. And if you're undertaking that risk, we say that, higher the risk, higher the return. So these ratios actually tell us if that is working or is justified by that scheme. And I think a look at these ratios can also really help investors select the right scheme for themselves, because if you look at returns of different schemes, even rolling returns, let's say if you're looking at comparable returns where a scheme has given 14 and the other has given 14.5% returns and you're indecisive, I think the ratios can, add a lot of value and give you additional information which can help investors filter the right scheme for themselves.
Okay, so let's break it down further. You spoke about the beta, standard deviation, Sharpe ratio. Let's understand the portfolio turnover ratio. This is a term which is often used in reports when it comes to mutual funds. Can you explain that to us, and what does that mean?
So mutual funds, of course, they buy and sell holdings which are part of their portfolio. And this is broadly seen as what was the buying and selling done by a mutual fund scheme in a year. So, for example, Sonal, that I, as a mutual fund manager, bought securities worth 1,000 crores, but I sold securities worth 800 crores in a certain year. And my AUM for the year is, let's say, around 1,200 crores. So what I would do is I would divide this 800, which is lesser of the two, the buying and selling, 800 divided by about 1,200, which gives us a percentage of 66%. So this is the portfolio turnover ratio. So the buying and selling, but not both of them together, and the lower of the two divided by the AUM. So broadly, it shows how actively the fund is managed or how frequently the stocks are bought and sold. And of course, this was higher for any actively managed fund. A passively managed fund is broadly a buy and hold strategy, or only when there is a change in the index, the scheme would exit from a certain stock holdings. At the same time, a lower portfolio turnover tells us that probably the fund manager believes in a buy and hold strategy. There is more conviction to the stocks that they're holding. And a higher portfolio turnover also results in slightly higher expenses for the fund, because obviously every buying and selling, incur a cost. And we are, looking at very different kind of schemes. So it's not that a lower or high, there's no clean way of saying that one of them is better than the other. We have schemes, a lot of schemes from UTI where portfolio turnover ratios is as low as 4 to 5%. So high conviction there, which is reflected, which is also a positive. And then we have a lot of schemes such as Quant, or if you look at the hybrid category, where the turnovers are really high. So I think if you're able to justify the decisions that you take, this is an important input, but not the only criteria.
Okay, we take that point. The next one is expense ratio. You mentioned that as well briefly. Is it really important for an investor to consider?
Expenses, yeah, I think we're also and increasingly becoming conscious about what the expense ratios are. And of course, we do see that there is a capping on how much expense ratio a scheme can have. But at the same time, there is an expense which is there for every scheme. And sometimes only for comparable schemes, a scheme may be charging a lesser expense ratio, depending on what your AUM is, because as the AUM size increases, as per SEBI, your expense ratio starts to go down. So it is dependent on a lot of factors, but broadly for an understanding of an investor, let's say that I'm, invested 5,000 rupees in a mutual fund scheme, and my expense ratio is 2%, which is of course on the higher side. So that 2% gets divided by 365 because the expense ratio is for the year, which was result in a percentage like 0.0054%, and this percentage is adjusted from my daily NAV. So it is not something which is a one-time charge. It is divided, throughout the year. So for only the holding period, let's say I invested only for 6 months, so I would be paying the expense ratio only for the 6 months. But of course, because it is a deduction from your scheme on a daily basis, it is of course, something that investors look at a lower expense ratio as a better criteria. And yes, that has to be, something that investors should look at. And also one thing that a passive scheme, because the buying and selling is lesser, usually have a lesser expense ratio.
Okay, so recently there was a consultation paper where SEBI was considering a uniform expense ratio across all the funds or the categories. Do you think that'll be helpful for investors?
I think that should be good actually, Sonal, because we did see last year there were reports that about 20% of the AUM moved during NFOs, from a regular scheme, which was existing schemes, towards these new fund offerings. And lower the AUM, your expense ratios can be high. Fund houses obviously want recent funds coming in for a new fund. And so the incentives offered to, for example, selling those schemes or pitching those schemes is higher. So I think if they have a uniform structure, this sort of mis-selling, if it is there, that can be avoided. And I think it'll just clear up, the hassle also of what is the expense ratio for which scheme. And, because we do get monthly reports on that within the fund house, that this is the expense ratio, or what are the payments which are made. So I think all of that can also be streamlined. It will become easier for investors. And I think the decision making will move away from just looking at what expenses are there for the scheme.
Makes sense. Last question, you mentioned Sharpe ratio. It's technical, we've studied it, but just for the ease of our viewers, can you explain that to us?
So like I said that, when we are incurring risk, we want that if we are taking risk, we are able to generate decent returns. And Sharpe ratio tells us the returns which are generated by the scheme, for example, and we subtract the risk-free returns or the industry returns from it. So depending on the situation, so let's say my scheme gave me 15% returns and the risk-free return is, let's say, 7%. So 15 minus 7. And then this number is divided by the standard deviation, which tells us how much volatility has been there. Because higher the volatility, higher is the risk for my scheme. So when we are looking at Sharpe ratio, this final number tells us what is the return that I'm getting for every unit of risk that I'm undertaking. So if we are comparing two schemes, I mean, on a standalone basis, this would tell us some information that if my scheme is, giving higher returns, let's say, than the industry benchmark, or the risk-free returns for the standard deviation, the volatility. But the ideal way to use it is for comparison. So if two schemes have the same level of risk, for example, which one is outperforming in terms of its performance. So these are the kind of information that Sharpe ratio can tell us. And I think it's an important measure while looking at different schemes.
Prableen, it's always such a pleasure speaking with you. It's a masterclass today, ratios which are generally a little complicated, but you made them easier for us. So thank you so much for this conversation, and we'll be speaking to you very soon again. Okay,
thanks, Sonal.
Okay, all right. With that, we'll take your leave on this edition of Mutual Fund YouTube Corner. Stay tuned for more news and updates.
Bandhan Mutual Fund presents MF Corner.